Dave Ramsey once looked straight into the camera and said, "The math is the math. If your portfolio earns 12% and inflation is only 4%, he explained you can safely withdraw 8% and still have growth left over. 7% if you want to be conservative. Anything less than that ridiculous?" Millions believed him. Millions followed the napkin math. And millions quietly ran out of money anyway. The most dangerous lie in retirement planning isn't a complicated Wall Street formula. It's the simple, comforting one that feels obviously correct. Today, we're investigating the retirement math that even the experts miss, the one that sounds bulletproof on paper, but collapses the moment real life shows up. But let's go straight to the source. In one of his most watched clips, Dave Ramsey looks into the camera and lays it out plainly. If you're making 12% in good mutual funds, he says, and the S&P has averaged 8%, while inflation over the last 80 years has averaged 4%, that leaves you 8. He's perfectly comfortable drawing 8, 7, if you want to be a little conservative. Anything less ridiculous. The math, he insists, is the math. It sounds so straightforward, so responsible. You earn 12%, you leave 4% for inflation, and you spend the rest. What could possibly go wrong? On a napkin, it adds up perfectly. Millions of Americans took that advice and built their retirement plans around it. But here's where our investigation begins to get uncomfortable. That 8% withdrawal felt safe on paper. Then we looked at the actual crime scene of 1973, and the portfolio did something no napkin could predict. Imagine a retiree in 1973 sitting down with a $100,000 portfolio. He does exactly what the experts recommended. He withdraws 5% every single year for the next 20 years. Over that full period, the portfolio averages 3% annual returns, well above what napkin math would ever demand for safety. On paper, it should have been a breeze. The retiree should have finished 1993 with money to spare and the account still growing. Instead, the portfolio was completely depleted. Every dollar gone by 1993. Wiped out. The money ran dry, even though the long-term average looked fantastic. Napkin math had promised he would still have 5.3% left over for growth each year. Reality delivered something far more brutal. Same starting amount. Same withdrawal rate. Same 20-year stretch. Yet the account died. That single simulation should have been enough to bury the napkin forever. But the real shock was still coming. Because we ran the exact same numbers again, same $100,000, same 5% withdrawals, same 10.3% average return, except this time we flipped the order of every yearly gain and loss. Same returns, same withdrawals. One portfolio died, the other tripled. How is that even possible? The next clue reveals the hidden killer. We ran the exact same numbers again. Same retiree, same $100,000 starting portfolio, same 5% withdrawal every year, same 20-year period, same 10.3% average return. The only difference was the order. We flipped the sequence of every gain and every loss. By 1993, that portfolio had not only survived, it had tripled. The retiree ended the period with 3 times the original money. 2 identical plans. 2 identical averages. 2 completely opposite fates. 1 account destroyed. 1 account thriving. The napkin math had no explanation. The returns were the same. The withdrawals were the same. Only the timing changed, and timing, it turned out, changed everything. The order of returns flipped the entire outcome, but the real damage only appears when volatility shows up in year 1. And that's exactly what happened in the next piece of evidence. But the order of returns only tells half the story. The real killer is volatility, and it strikes hardest in the first year. Take the exact same sequence of market returns from 2003 to 2022. The kind of period investors dream about on paper. Same average return. Same withdrawal rate. The only difference between 2 simulations is that we swapped the first and last year. One retiree starts with a 29% gain. After withdrawing $60,000 that first year, the portfolio is still sitting above $1,200,000 and keeps climbing. The other retiree opens with an 18% loss. After the same $60,000 withdrawal, the portfolio shrinks to roughly $760,000. Year 2 arrives and both portfolios earn 11%. But 11% on $1,200,000 easily covers the withdrawal and still grows the account. 11% on $760,000 barely covers the withdrawal and leaves almost nothing for recovery. From that moment, the gap never closes. It widens every single year. One retiree coasts comfortably. The other fights for survival. The difference wasn't the average return everyone quotes. It was the order. Downside volatility in year 1 had already done the damage. One retiree ended year 1 with $1.2 million. The other with $760,000. The gap never closed. But the most painful irony is still coming, when we apply the exact same logic to buying a house. Clue number 5 widens the lens to nearly a century of real-world data. We mapped every possible 30-year retirement window from 1928 through 2024 using a 60-40 portfolio. On the graph, the x-axis shows the real return after inflation. The y-axis shows the highest withdrawal rate the portfolio could actually sustain without running dry. If napkin math were correct, the dots should form a clean upward line. Higher average return equals higher safe withdrawal rate. They don't. The scatter is chaotic. Look at 2 specific periods that prove the point. In 1950, the portfolio delivered a real return of 3.9%, yet supported an 8% withdrawal rate. In 1966, the same portfolio delivered a higher real return of 4.1%, but could only safely sustain a 3.7% withdrawal rate. Higher average growth produced a much lower safe spending level. The graph doesn't lie. Higher average return, lower safe withdrawal. But wait until you see what this same math does when you try to earn the spread on a mortgage. But the most painful irony is still coming when we apply the exact same logic to buying a house. Picture a $1 million home with current mortgage rates around 6.25%. On a 30-year loan, the monthly payment runs $6,200. Annualized, that's roughly $74,000 a year, covering both principal and interest. That's the equivalent of a 7.4% withdrawal rate from a $1 million portfolio. Napkin math says, take the loan, keep the million invested, and enjoy the spread. Easy money. Yet when honest math ran the actual simulations assuming a portfolio return just over 5% against a 3.5% mortgage, they discovered a 46% chance the investor would lose money by taking the loan. 46%. Dave would cheer an 8% withdrawal in retirement because the math is the math. But he'd call the identical 7.4%, disguised as mortgage payments financial suicide. The same numbers. 2 different labels. 2 completely opposite verdicts. Here is the final reveal. The fatal flaw was never the size of the returns. It was the quiet assumption that those returns would arrive in a perfectly straight, predictable line, year after year. Sequence of return risk. Especially brutal downside volatility in the first 5 years is what actually decides whether your retirement survives. A bad sequence cannot be rescued by a higher average return. Napkin math collapses the moment real volatility shows up because the order of the numbers matters far more than the average everyone quotes. That single truth explains every paradox we just uncovered. The math everyone trusted was never the math that mattered. So what now? The case of 1973 is closed. The real math isn't comforting, but it's honest. 3 proven ways to survive instead of becoming the next victim of napkin math. First, choose a conservative withdrawal rate 3 or 4% to brute force your way past sequence risk. Historically, that rate has survived every 30-year period since 1928. Second, use a reverse equity glide path. Start retirement heavy in safe assets to shield those critical early years, then gradually increase stock exposure later when your portfolio can handle volatility. Third, adopt flexible spending. If the portfolio drops sharply, cut. Withdrawals temporarily, like the couple with $2 million who trimmed $14,000 a year during the 2008 crash, then raise them again once the market recovers. The napkin math that sounded so bulletproof on Dave Ramsey's napkin has been exposed. The order of the numbers matters far more than the average everyone quotes. Check your own plan tonight. Ask yourself one question: am I still trusting the napkin? Or have I finally looked at the sequence drop the withdrawal rate or mortgage spread idea you're currently using in the comments? Let's keep investigating together.